Welcome everybody. In this short video, we're going to look at the issue around scaling your trading, and we've titled this Level Up Without Blowing Up. It's something that very few people actually talk about, but it is really essential in terms of your ongoing success as a trader. Let's just start by asking the question, what is scaling in trading? And as a definition, scaling is intentionally increasing the position size for trades you take based on evidence of trading consistency. Now, of course, there are two components to this, but the latter is most important. It's something that you do when you have evidence that things are doing well in your trading systems. It's different from passive growth. Obviously, over time, we can see an account grow in size if we're having consistent good trading outcomes. And so, if we are operating on a risk tolerance level of perhaps 1% of our account risk for every trade, then over time, that's going to obviously increase the lot sizes we take. But this is actually the decision to move from, say, from point one to point two, or from point two to point five, or from 500 CFDs to 700 CFDs to 1,000 CFDs. So I just wanted to differentiate that right now, just to make it absolutely crystal clear what we're talking about. It's really important to stress that this is therefore a form of performance-based aggression, not random risk taking. We're not just feeling the force and putting however many lots onto the market. What we're doing is we are systemizing the process of increasing how we trade. So on that point, really, it makes sense that if we do need to have a structured progression, we need a plan to do that. And if you look at your overall trading system, this concept of trading as a business, then scaling should be a component part of that. It shouldn't be just a side idea which you sort of plug on and then have a little go at. It should be formally integrated into your trading system as a whole, and should answer the question about when are you going to scale and by how much, as we will talk about as we go through this video. What this does essentially is it helps prevent emotional or impulsive size increases, which are a common thing in traders, but rather bases this progression on proven reliability of results. So, consequently, of course, one of the key attributes of this is we need to have a feedback loop from our results to our scaling decisions. So, we need evidence as the guide as to when we scale. So we should only scale when there's consistency in strategy performance, and that's strategy performance, not the account as a whole generally, confidence and consistency in execution. And what I want you to do is ask, what would reliable results look like for me? So is it that you have a 70% win rate with a 10% a month growth in your account? What would it actually look like that says, right now the time could be right to consider scaling from where I am now and the lot size I'm taking now to what I'm going to do going forward? It's important within that you use actual metrics. We've talked about that in other videos, not just a gut feel. So we need to look at things like the net profit, the average win, average loss, the drawdown, the Sharpe ratio, the recovery factor. All of these metrics we can subsequently then use as criteria for now's the right time. Now, it's probably important, as there are no doubt many of you who have got quite a substantial amount of trading experience watching this video, but also there may be some beginners. And what we would suggest is, in the first instance, perhaps scale your strategies based on experience. So, what we might do is, if you're a beginner and you've got a few strategies there that are working well for you overall on your account, so what we could do is potentially do light scaling across all trades. So perhaps move as a standard from 1% risk to 1.5% risk. We need to take baby steps. We need to be careful. We need to grow it evenly as we go. So we may say we're going to increase our scaling by half a percentage point risk when it meets X criteria. And then we can do it again when it continues to meet those criteria, perhaps in 2 or 3 months' time. If you're trading already at an intermediate advanced level, and providing, of course, you're recording those metrics we talked about previously, we can look at a historical performance of individual strategies. So we may have a breakout strategy which is outperforming, it's maybe sort of 80% win rate, or we may have a reversal strategy which has a 55% win rate. Obviously, the logical thing to do is not only to look at this and see if there's any way we can improve the metrics on the lower performing strategy, but also we can use that to guide what we're actually scaling in. So in that example, we may scale on the breakout strategy first. So we may, in fact, have a threshold for each strategy that says once it hits this specific criteria, then we're going to go for it. And this is what we term selective scaling. So if you have some experience, you have a critical mass of trades under your belt that you can evaluate by strategy, then selective scaling is perhaps the way to go for you. We need to obviously continue to monitor outcomes closely. As with any intervention on our trading system, we can't just put it up there and let it do its thing and leave it without looking at it. So part of your scaling plan, you need to formalize a review to see the impact of your scaling on your results overall. The next question, of course, is to build upon that how much we scale. It's key to stress that small steps matter. We should make the increments of the scaling manageable. We've got a few things we need to deal with, which we are going to talk about in a moment. But we need to avoid doubling up suddenly. That's gambling, not scaling. We need to have evidence that, yes, our new and improved risk level, the strategy that we've chosen to scale up is actually still performing. So perhaps as part of your scaling plan, you should have, right, we're going to move from this level of risk to this level of risk to this level of risk. That's making sense. And that's been safe while you're doing it. So, for example, move from 0.1 to 0.15 lots, then 0.15 to 0.2, only, as I said before, when set criteria have been met. You need to plan that out for whenever is right for you, of course. There are some emotional challenges with scaling. Obviously, with scaling, we're going to be trading with bigger numbers. And of course, bigger numbers will create a bigger emotional reaction. Even if it's exactly the same strategy using the same entry and exit criteria, $100 win feels very different than $1,000. And of course, $100 loss feels very different than $1,000 loss. So you must train your mind to handle larger drawdowns and larger wins. The danger is, of course, if you're used to taking $100 profit, all of a sudden, with your new scaling, you see it at 150, even though the strategy itself has further to run, you take it off just because it feels bigger. Likewise, if your standard stop is at $200 to the downside and your scaling means that you see a trade which is now at 250 or $300 and you take it off, even though in terms of your trading plan, it isn't time to do that. And the reason people do that is they focus on the numbers, not on the trade itself. So with scaling, we're not actually changing the criteria for entry and exit. With scaling, what we're doing is doing exactly the same, but just on bigger numbers. And that is something that you'll have to manage. I'm going to talk about ghost trading in a minute, but obviously journaling can also help for this. And if we talk about using ghost trading as a tool, what we mean by this is ghost trade exactly the same trades at a higher size in a demo account. This is one of the strengths of having a demo account alongside your live account is you can get used to those bigger numbers. So what we would do is maybe if we're trading zero point 0.1 on our live account, we would maybe trade 0.5 on our ghost account just to get used to the real bigger numbers psychologically. So the benefits of this is it obviously emotionally prepares you for those larger profit and loss swings, which you're going to see if you're trading higher volumes. And it also, should your ghost account be doing well, it builds motivation with the look what I could have made scenario to actually get you to take positive action, not just procrastinate and stay at the same level. I hope that makes sense. It helps act almost as a psychological stepping stone to moving up to the next level and then the next level again. It does obviously require a little bit of discipline to open trades in a yet another account just to mirror them, but the psychological benefits of doing that could be significant. So here's a 5-point scaling checklist. First of all, have you proven consistent results? Remember, we do this on evidence, not on a whim. Is there a defined strategy system in place? And have we identified which ones are working well and perhaps are ready for scaling and which ones perhaps need some more work on the strategy itself before you consider scaling? Are you emotionally ready? Have you opened a ghost account? Are you going to be able to handle the bigger numbers, both on the profit and the loss side of things, without intervening prematurely? And have you a set stepped plan to know how much and when you're going to increase? And as I said before, the merits of practicing via ghost trading are going to put you in a good place. So, in terms of your scaling plan, this checklist should be part of that, and then obviously build in the detail around it. So, final thoughts on this: scaling isn't just about ambition, it's about earned progression. You've got to do the work at the front end to get to a stage where your strategies are producing consistency in results and you've got the discipline of execution. Your reward for that is you're putting yourself in a position where you can scale, of course. Remember, small, well timed steps beat big emotional leaps. And although it's your call as to how spaced these steps in lot size are, if you pre-plan it and stick to it, and of course have those criteria to tick off to say, right, now's the time to go again and go again, then you'll be in a far, far better place. So your job from this video is to prepare for scaling, test some things out, including potentially simulate the trading on a ghost account. And then, of course, as you move to scaling, make sure that you review. Those four things are going to be necessary for your trading growth and hopefully, of course, increasing gains in your trading account. Hope that's useful. Trade safe and see you again soon. Bye bye for now.